The Federal Reserve's decision to raise interest rates by 0.75% or 75 basis points for the third consecutive time at the Federal Open Market Committee meeting is a step being taken to cool the economy and bring down inflation, but it is also putting small business owners across the country in a lending fix they have not experienced since the 1990s. If the Federal Reserve's FOMC next moves match the market's expectation for 2 more interest rate hikes by the end of the year, small business loans will reach at least 9%, maybe higher, and that will bring business owners to a difficult set of decisions. Businesses are healthy today, especially those in the rebounding services sector, and credit performance remains good throughout the small business community, according to lenders, but the Fed's more aggressive turn against inflation will lead more business owners to think twice about taking out new debt for expansion. Welcome to Savvy Economists. Today in this video we would be discussing the recent increase in the interest rate by the Fed and its implication to an economy already hanging on a thread. As we go into the details, hit the like button, subscribe and turn on notifications. The Federal Reserve raised interest rates by 3/4 of a point on Wednesday as it tries to strangle inflation by tamping down economic demand. The central bank also sharply downgraded its economic forecast, with its median expectation of growth in gross domestic product now at 0.2% for the year, down from 1.7% in June. Unemployment will reach 3.8% this year, up from 3.7% earlier, and 4.4% for each of the next 2 years. The Fed also raised inflation expectations to 5.4% this year from 5.2% in June, while also lifting its inflation forecast for 2023 to 2.8% from 2.6% and for 2024 to 2.3% from 2.2%. The Fed's forecast also sees it raising rates to a peak of 4.6% in 2023, up from 3.8% in its June summary of economic conditions. Fed Chairman Jerome Powell spoke after the announcement, and while noting a slowdown in economic activity, particularly in housing and business investment, he said the labor remained out of balance with demand for workers outstripping supply. "We are taking forceful and rapid steps to moderate demand," Powell said. "We will keep at the job until we are done." Powell suggested the idea of a soft landing where inflation comes back down to the preferred goal of a 2% average is diminishing the longer the Fed keeps tightening, but he added that no one knows if or when a recession will occur or how severe it might be. He said the Fed would rely on the incoming data, and at some point, it would need to assess its policy and, where appropriate, to slow the rate of interest rate hikes. "We are committed to getting to a restrictive level and getting there pretty quickly," he said in answer to a question about upcoming meetings and rate decisions. "Inflation is not where we want it to be," he added. The Fed was late to recognize inflation, late to start raising interest rates, and late to start unwinding bond purchases, said Greg McBride, chief financial analyst at Bankrate. "They've been playing catch-up ever since. And they're not done yet." The 75 basis point hike follows a similar increase in July that has put the brakes on the housing market amid an overall slowdown in the economy. The increase will put further pressure on both consumers and businesses as borrowing costs rise and the prospect of a recession increases in the next several months increases. Today's rate increase will have a quick impact on consumers, particularly for shorter-term borrowing costs, said George Raichu, Realtor.com manager of economic research. The funds rate serves as a basis for the prime rate, which is used by banks to set interest rates for credit cards, as well as automobile and personal loans. "Consumers will see higher rates in the next few weeks," Raichu added. "This is expected to have a spillover effect later this year as we move into the traditional holiday retail season. With higher borrowing costs and incomes that are not keeping up with inflation, consumers may find shrinking shopping budgets, leading to a shorter gift list." Raichu said the rate hikes will affect more than just consumers and that businesses are already facing inflation and rising wages for their workers. In addition, with an increasingly likely economic slowdown on the horizon, many companies are moving to contain or cut back on expenses, he said. "While layoffs have been limited to certain sectors to date, we may see a growing wave of companies cutting payrolls during this winter." Markets sold off on the news, with the Dow Jones Industrial quickly falling more than 200 points. However, the Dow reversed itself as Powell spoke, rising 280 points before settling closer to a 200-point gain in volatile trading. As traditional banks and credit unions tighten lending standards and businesses begin to breach debt covenants based on debt service coverage ratios, the amount of cash flow needed to cover debt, more business owners will turn to the SBA loan market, in which firms like Hearn specialize. "Every time we get into one of these cycles and the economy is slowing and rates are going up, one of the few places to get business credit is SBA lenders," he said. But even in the SBA market, business owners are beginning to pause as a result of the Fed's rate actions, said Rohit Arora, co-founder and CEO of Biz2 Credit, which also focuses on small business lending. From a credit perspective, people are getting more cognizant about increasing interest cost and that the Fed will keep interest rates at April 4th, 50%, Arora said. Fed officials signaled the intention on Wednesday of continuing to hike until the funds level hits a terminal rate, or endpoint of 4.6% in 2023. Even a month ago, this was a 2022 phenomenon, and now they will have to live with the pain for longer, Arora said. It's a harder decision now because you don't have the Fed put behind you, he added, referring to an environment in which you could bank on adjustable loan rates not going higher. The big change since the summer, reflected in the stock market as well, is the acknowledgement that the Fed is not likely to quickly reverse its interest rate hikes, as inflation proves stickier than previously forecast, and key areas of the economy, like the labor market, don't cool fast enough. As recently as the last FOMC meeting in July, many economists, traders, and business owners expected the Fed to be cutting rates as soon as early 2023. Now, according to CNBC's surveying of economists and investment managers, the Fed is likely to reach peak rates above 4% and hold rates there throughout 2023. This outlook implies at least 2 more rate hikes in November and December, for a total of at least 75 basis points more, and including Wednesday's hike, 150 basis points in all from September through the end of the year. And that is a big change for business owners. The FOMC meeting decision reinforced this expectation of a more hawkish Fed, with the 2-year Treasury bond yield hitting its highest rate since 2007 and the central bank's expectations for when it starts cutting rates again pushed out even further in time. In 2025, the Fed funds rate median target is 2.9%, implying restrictive Fed policy into 2025. SBA loans are floating rate loans, meaning they readjust based on changes in the prime rate, and that has not been an issue for business owners during the low interest rate environment, but it is suddenly becoming a prominent concern. With SBA loans based on the prime rate, currently at 5.5%, the interest rates are already between 7% and 8%. With the prime rate poised to reach 6.25% after the Fed's latest 75 basis point hike, SBA loans are heading to as high as the 9%-9.5% range. Most of the business owners today, because they have lived in such a low-rate environment, while they have floating interest rate loans, they didn't even realize that on existing loans it could go up, Arora said. Everyone expected with gas prices coming down to what I would call pre-high inflation levels that things looked a lot better. Now people are realizing that oil prices don't solve the problem, and that's new for lots of business owners who thought inflation would taper off and the Fed not be so hawkish. He stressed, like Hearn, that demand for business loans is still healthy, and unlike deteriorating consumer credit, small business credit performance is still strong because many firms were underleveraged pre-COVID and then supported by the multiple government programs during the pandemic, including the PPP and SBA EIDL loans. They are well capitalized and are seeing strong growth because the economy is still doing pretty well, Arora said, and he added that the majority of small businesses are in the service economy, which is the strongest part of the economy right now. But many business owners were waiting for the Fed to cut in early 2023 before making new loan decisions. Now, they've been caught flat-footed by adjustable loan rates that went up and an interest rate environment poised to go higher still. Lots of business owners look at gas prices first, and that was true for most of the year, and now it's broken down. Wage inflation and rent inflation are running amok, so we're not seeing inflation coming down anytime soon, Arora said. That's leading to more interest in fixed-rate products. Demand for fixed-rate loans is going up because businesses can lock in rates from a year to 3 years. Though it's pretty late to the game, they feel like maybe the next 14 to 15 months, before rates start coming down, they can at least lock in a rate, Arora said. The expectation is, in the short term, SBA loans will adjust up and non-SBA loans are shorter tenure, he said. SBA loans range from 3 years to as long as 10 years. A fixed-rate loan, even if it is a little higher than an SBA loan today, may be the better option given the change in interest rate outlook. But there's considerable potential downside. Trying to time the Fed's policy has proven difficult. The change from the summer to now is proof of that. So if there is a significant recession and the Fed starts cutting rates earlier than the current expectation, then the fixed-rate loan becomes more expensive, and getting out of it, though an option, would entail prepayment penalties. That's the one big risk you run if taking a fixed-rate loan in this environment, Arora said. The other trade-off in choosing a fixed-rate loan, the shorter duration, means a higher monthly repayment amount. The amount a business can afford to pay back every month depends on the amount of income coming in, and a fixed-rate loan with a higher monthly repayment amount requires a business to have more income to devote to servicing the loan. After 2008, business owners never experienced a jump in SBA loans, and now they see monthly interest payments increasing and are feeling the pinch and starting to plan for it, get adjusted to the new reality, Aurora said. Demand is still healthy, but they are worried about the increased interest cost while they are still battling inflation, even as lower oil prices have helped them. Another cost that is suddenly influencing the SBA loan decision is the end of a waiver this month on SBA loan guarantee fees that are traditionally charged to borrowers so that in the event of a default, the SBA pays the portion of the loan that was guaranteed. With that waiver ending in September, the cost of guaranteeing a loan can be significant. For example, a 3% SBA guarantee fee on a $500,000 loan would cost the business borrowing the money $5,000 within the next year or two. As higher rates restrict economic activity, Fed policymakers expect growth to weaken substantially. The central bank expects to cut the Fed funds rate by about 3/4 of a point in 2024, presumably in response to a slowing economy or possibly a recession. What does an interest hike mean for you as a day-to-day consumer, and how do you think it affects you and your business now? Let us know what you think in the comment section. Don't forget to like, subscribe, and turn on notifications. Thanks for watching.